Hey everyone, the new tax law has officially been signed, and for retirees, this is a big deal, especially when it comes to how you plan your retirement for tax efficiency. And by the way, that needs to be one of the big considerations when you're thinking about how you're going to create retirement income. I mean, you can have all the savings in the world, you can have a great portfolio, you can have diversified income streams. But if you're not thinking strategically about taxes, you could be leaving tens of thousands of dollars on the table over the course of your retirement. And that's money that could have been spent on travel, on family, on the things that matter most to you, or simply providing you with more financial security and peace of mind. Now, there's a lot that we can talk about with this new legislation, but the most important thing to know right now is this. You have a 4-year window to take advantage of what I think is a powerful planning opportunity. All of these changes are not set in stone and made permanent where they're forever. Some parts of the law are going to be permanent, and that's actually really good news because it removes some uncertainty that's been hanging over retirement planning for years. But others, like the senior bonus deduction and the expanded SALT deduction limits, are only available from 2025 through 2028. And that means the 4 years ahead of us may be the best chance to act. This isn't a situation where you can just sit back and say, well, I'll get to it eventually. Eventually means the window closes, and once it closes, the opportunity is gone. And in this video, I'm going to walk you through what the new law means for your retirement plan. So what's changed? What's staying the same? And most importantly, how to make the most of this planning window while it's still open. Now, before we dive in, make sure that you've downloaded my free guide, the one critical portfolio shift you must make before retirement. The wrong investment strategy in early retirement can do a lot of lasting damage, even for those who have saved really well and have a lot of money. I've seen it happen time and time again where people enter retirement with what looks like plenty of assets, but because they haven't positioned their portfolio correctly, they end up running into sequence of returns risk. They take withdrawals at the wrong time. The market drops, and suddenly their entire retirement plan is compromised, and this guide is going to show you how to mitigate the sequence of returns risk, how a traditional 60-40 portfolio can fall short, especially in today's environment, and how a simple shift can bring more confidence and clarity to your income plan. You can get that by using the link down in the description. So there's a lot packed into this new tax law, and we couldn't possibly cover everything in one video. We could spend time on the expanded child tax credit, which affects families with younger children. We could talk about the changes to charitable giving, which I think is important, especially for those of you who are charitably inclined and want to maximize the impact of your donations while also getting some tax benefits. There's the temporary deduction for auto loan interest, which could matter if you're planning to purchase a vehicle in the next few years, or even the expanded SALT deduction, which, by the way, is going to be a big deal for some households, especially in certain states like California, New York, New Jersey, and other high-tax states where property taxes and state income taxes can really add up. For people in those situations, the expanded SALT cap could mean thousands of dollars in tax savings. But today, I want to narrow the focus and look at the provision that I think creates the most broad-based planning opportunity for retirees, and that's the increased standard deduction, including the new bonus deduction for those over 65. This is where retirees can take real meaningful action while the tax law is in effect, and where its potential for long-term tax savings is the greatest. This is the provision that's going to affect the most people watching this video, and it's the one where I think you can really move the needle if you understand how to use it strategically. But, really first and foremost, the biggest change in this law is that it makes the lower tax brackets and larger standard deduction permanent. And I want to pause there because permanent is a word we don't hear very often when it comes to tax policy. Usually tax changes come with sunset provisions, they come with expiration dates, they come with uncertainty. But this time, Congress has actually made some of these provisions permanent, which means you can plan around them with confidence. You don't have to worry about them disappearing in a few years. Until recently, most retirement planning assumed that the 2017 tax cuts would expire at the end of 2025, and that would have meant higher tax rates across the board. A lot of the planning I was doing with clients over the past few years involved this looming deadline. We were trying to figure out, should we accelerate income? Should we do Roth conversions now before the rates go up? Should we harvest gains? There was a lot of uncertainty, and uncertainty makes it really hard to plan effectively. So, for example, the 12% bracket would have jumped back to 15%, the 22 back to 25%, the 24 back to 28%, and so on. And at the same time, the standard deduction would have decreased and the personal exemptions would have returned. But according to the Tax Foundation, all of that combined would have resulted in tax increases for about 62% of Americans. So we were looking at a scenario where the majority of taxpayers would have seen their taxes go up, in some cases significantly. So this new law removes that uncertainty, and we now have permanently lower brackets and a higher standard deduction that will continue to be adjusted for inflation. And that inflation adjustment is important too, because it means the standard deduction won't lose its value over time. It'll keep pace with the cost of living, which provides some built-in protection against bracket creep. And I want to hit the pause button on that point because it's easy to gloss over this. But knowing how the standard deduction works is critical to understanding your overall tax. I mean, if you don't understand the mechanics of how your taxes are actually calculated, it's really hard to make smart strategic decisions. So let's take a quick look at the tax formula and see how that works. So you start with your total income, which includes everything you earned during the year. This could be wages if you're still working. It could be Social Security benefits, pension income, IRA distributions, interest, dividends, capital gains, rental income, whatever it is. It all starts here with your total income. Then you subtract above the line deductions. So like contributions to an HSA or a traditional IRA, student loan interest if that applies to you, educator expenses if you're a teacher, things like that. These are deductions you get whether or not you itemize. And what's left is your adjusted gross income, or AGI. And your AGI is actually a really important number because a lot of things in the tax code are tied to it. It determines whether you qualify for certain credits, certain deductions, whether your Social Security is taxable, how much of it is taxable, whether you're subject to IRMA surcharges on Medicare. So AGI is kind of the linchpin number in your tax return. And then from there, you subtract either your itemized deduction or the standard deduction, whichever is greater. Now, itemized deductions include things like mortgage interest, state and local taxes up to the cap, charitable contributions, medical expenses that exceed a certain percentage of your AGI, things like that. You add all those up, and if they're more than the standard deduction, you itemize. If they're not, you take the standard deduction. And for most retirees, especially once the mortgage is paid off, the standard deduction is going to be the way to go. And that leaves you with your taxable income. And that's the amount that gets applied to the federal tax brackets to figure out how much tax you owe to the IRS. So the standard deduction is essentially a tax-free zone. It's the amount of income the IRS lets you automatically exclude from taxation with no forms or itemizing required. You don't have to keep receipts. You don't have to justify it. You don't have to prove anything. It's just automatic. And that becomes especially important in just a moment when we talk about the new senior deduction that's available through 2028. You know, one thing that's been missed in a lot of the articles I've read is that the standard deduction isn't just staying at its current level, it's actually being enhanced. And I'm not talking about the additional $6,000 senior bonus deduction yet, but we'll get to that in a moment. But starting in 2025, the standard deduction is going to increase by $1,500 for joint filers and $750 for single filers. So that's going to bring the standard deduction up to $31,500 for a married couple that's filing jointly, and $15,650 for a single filer. And that's on top of the regular annual inflation adjustment. That would have happened anyway. So this is a real increase, a real enhancement to the standard deduction. And then if you're over the age of 65, you can get an additional deduction on top of that. And this is something that's been around for a while. It's not new, but it's worth mentioning because it layers on top of everything else we're talking about. So It's $1,600 per qualifying spouse if you're filing jointly. And if you're filing single and over the age of 65, it's an additional $2,000. So in total, a married couple filing jointly with both spouses over the age of 65 will have a standard deduction of $34,700 in 2025. And a single filer over the age of 65 is going to have a standard deduction of $17,750. So in real terms, that means that nearly $35,000 of income for a retired couple will be completely shielded from federal taxes before any other deductions or credits even come into the picture. Think about that for a second. $35,000 of completely tax-free income. So if that couple has an AGI of $100,000, just a little over $65,000 would be considered taxable income. And again, to be clear, this does not include the senior bonus deduction that's available through 2028. We'll talk about that next, but I did want to just make sure that we didn't overlook just how important these standard deduction changes are on their own. Because even without the bonus deduction, this is a significant benefit for retirees. So now let's talk about the brand new senior bonus deduction, which is completely separate from that standard deduction that we just covered. And this is where things get really interesting from a planning perspective. So starting in 2025, the new deduction is $6,000 per qualifying individual who is over age 65. So for a married couple where both spouses qualify, that's up to $12,000 in additional deductions. Now, what makes this especially valuable is that it applies whether or not you itemize. So if you do itemize, you can add this deduction on top of your itemized deductions. But for most people, those who simply take the standard deduction, this bonus stacks right on the top. So for 2025, the effective standard deduction for a married couple over the age of 65 will be $46,700. So that's $31,500 for the standard deduction, $3,200 for the regular over age 65 increase, and $12,000 from the senior bonus deduction. That is a massive amount of tax-free income. I mean, we're talking about nearly $47,000 that you can earn without paying a dime in federal income tax. But there are two really important things that you have to know about how this senior bonus deduction works. First, it starts to phase out once your income gets over a certain level. That phase out starts at $75,000 for single filers and $150,000 for those who are married filing jointly. Once you cross those thresholds, the deduction begins to reduce and it phases out completely at higher income levels. Now, the exact phase-out mechanics can get a little complicated, but the key point is this. If you're a married couple with income over $150,000, you're going to start losing some or all of this bonus deduction. So this is where strategic planning really comes into play. If you can manage your income to stay under those thresholds, you get the full benefit. If you're going to be over anyway, you might want to think about timing. Maybe you take a larger distribution one year and a smaller one the next, rather than taking the same amount every year. And second, and this is critical, the senior bonus deduction is only available for tax years 2025 through 2028. So we're looking at a 4-year planning window. And this 4-year window isn't just something to note in your head. It's something that you need to plan around. You need to put it on your calendar. You need to build your tax strategy around it, because once 2028 ends, this goes away, and we don't know if Congress will extend it. We don't know if they'll make it permanent. We don't know what the political landscape will look like at that point. What we do know is that right now, for the next 4 years, you have this opportunity. For many retirees, it creates a rare opportunity to lower your lifetime tax bill by making smart moves while these deductions are available. And when I say lifetime tax bill, I really mean that, because the decisions you make in these next 4 years could impact your tax situation for the next 20, 25, 30 years of retirement. So if you're considering, say, for example, Roth conversions, the next 4 years could be your sweet spot. With the enhanced standard deduction and the senior bonus deduction, you can convert more to Roth while keeping your taxable income in a lower bracket, and in some cases without triggering any federal taxes at all. Let me give you an example. Let's say you're a married couple both over 65, and you have $46,700 in standard deduction. You could potentially convert $46,700 from a traditional IRA to a Roth IRA and pay zero federal income tax on that conversion. Now, you'd still have to think about state taxes depending on where you live, and you'd have to make sure you're not triggering other issues like IRA or affecting the taxation of your Social Security. But from a pure federal income tax standpoint, you could move almost $47,000 into a Roth IRA tax-free. And then that money grows tax-free, comes out tax-free in retirement, and doesn't count toward your required minimum distributions later. That's huge. Or maybe you've been holding on to appreciated investments in a taxable brokerage account. Well, this window gives you a chance to harvest some gains and maybe just reset your cost basis, possibly while paying little or no tax, because now you have a standard deduction that's much higher. Normally, if you have long-term capital gains, they're taxed at 0%, 15%, or 20%, depending on your income. But if your taxable income is low enough, you can actually realize capital gains and pay 0% on them. So if you have stocks or mutual funds that have appreciated significantly, this might be the time to sell them, pay no tax, and then immediately buy them back. You've now reset your cost basis to the current market value, which means if you sell them later, you'll have less gain to recognize. It's basically a free step up in basis. And if you're coordinating withdrawals from pre-tax accounts like IRAs, this could be an ideal time to smooth out your income, avoid those future tax spikes, and make your required minimum distributions more manageable down the road. One of the biggest mistakes I see retirees make is they don't take any distributions from their IRAs until they're forced to at age 73. And then all of a sudden, their RMDs are huge. They're getting pushed into higher tax brackets. Their Social Security is getting taxed at a higher rate. They're paying RMA surcharges, and they're looking back thinking, why didn't we start taking distributions earlier when we were in a lower bracket? This 4-year window is your chance to avoid that scenario. You can start taking strategic distributions now, filling up these lower brackets, taking advantage of these higher standard deductions, and essentially prepaying some of your future RMDs at a lower tax rate. It's like going to the grocery store and stocking up when there's a big sale. You're buying something you're going to need anyway. You're just buying it when the price is better. Now, there's really a lot of paths that we could go down here in the planning opportunities this will create, but the bottom line is that you don't want to waste these next 4 years, and I want to be really clear about what I mean by waste. I don't mean you have to do something dramatic or risky. I don't mean you have to completely overhaul your entire financial plan. What I mean is you need to be intentional. You need to be strategic. You need to think through how you can use this window to your advantage, because the default approach, the approach of just doing the same thing you've always done, that's probably not going to be optimal in this environment. Once 2028 ends, this window is going to close. So whether you're already retired or you're getting close, now is really the time to take a fresh look at your tax strategy and put this window to work for you. And look, I get it. Taxes can be complicated. They can be boring. They can feel overwhelming. But this is one of those areas where a little bit of planning can make a big difference. We're not talking about some exotic tax strategy that requires a lot of paperwork and complexity. We're talking about fundamental bread and butter retirement tax planning, just with a really favorable set of rules for the next 4 years. So don't wait. Go talk to your advisor, run the numbers, and make sure your plan is designed to take full advantage of this opportunity while it lasts. And if you don't have an advisor, or if you're not sure your current advisor is really digging into the tax planning side of things, that's something you need to address, because financial planning isn't just about picking investments and managing risk. It's about integrating all the different pieces, the investments, the taxes, the income planning, Social Security timing, Medicare planning, all of it working together. And if you don't have a clear plan that gives you confidence, you can find out how to get in touch with me and my team down in the description. And also remember to download your free copy of my newest guide, The One Critical Portfolio Shift You Must Make Before Retirement. This guide is going to complement everything we talked about today because it's not just about taxes, it's about making sure your portfolio is positioned correctly for the distribution phase of your life. Because you can have the best tax strategy in the world, but if your portfolio isn't structured to support sustainable withdrawals, you're still going to run into problems. So grab that guide, take a look at it, and make sure you're thinking holistically about your retirement plan. Thanks for watching, and I'll see you in the next video.